I'm Charlotte McLeod with investingease.com, and here today with me is Tavi Costa, macro strategist at Crescent Capital. Thank you so much for being here. Great to have you.
Thanks for having me. Yeah.
Really good to be catching up with you. It's been a little while. I was looking back. It's been about a year since we last spoke, and it was back when many people were still looking at gold and they were wondering, is this move real? And I think you were pretty confident at that time. You said it's more sustainable than people were thinking, probably going to go a lot higher.
Yeah.
So, and it has. Has gold's price activity, has the level of the price and the quickness of the move surprised you, or is this in line with what you thought?
No, I think it surprised me as well. What surprises me the most is that we haven't seen a follow-up of other things. Gold prices have gone up significantly. I think we've had a big change in the whole thesis. Yeah, central banks have been buying gold, but with the new administration and this focus from Scott Bessent, the new Treasury Secretary, talking about, a monetary alignment and all these discussions that are usually big turning points in history, I can't ignore the fact that we're, today running one of the lowest U.S. gold reserves in history, probably a 90-year low. It's a little scary. It's a little, I think these things become more relevant at times, and I think we're at that time right now. And so clearly, a lot of people are learning a history lesson, kind of like a crash course about gold. But ultimately, that tends to actually lead to other things like silver, the miners. I think we're at the golden age of mining. So there's a lot of really interesting opportunities that are tied up to gold that we haven't seen yet play out.
Yeah, I think many investors would probably identify with that kind of lack of follow through.
Yeah.
So let's talk a little bit more about gold and the U.S.
Yeah.
I know Crescent Capital just published a pretty interesting piece, which I'll link in the video description, on U.S. gold reserves. And as I understand, the basic premise is that the U.S. is ultimately going to have to add to its gold reserves. So can you talk about that? It's pretty interesting.
Yeah, well, I think a country can run with a lot of leverage for a long time until the cost to service that debt starts to really eat into your GDP growth. And what is that level that starts to really become an issue? I think that about 4 to 5% of growth just to pay down debt is when you start seeing some problems and beginning to see changes of prioritization of policy. So what is the policy right now? The policy is to reduce interest rates, no matter what. 10-year, 30-year Fed funds rate, everything needs to be brought down. So how do they accomplish that? Well, we got to bring back discipline. Austerity is one of the plans, is the idea of Doge. But also, in my view, is interesting how we have to reduce interest rates also to reduce austerity or to accomplish austerity because majority of the government spending is actually to service the debt. So it's sort of, it's kind of a chicken and egg question. But in my view, this is absolutely critical. And the U.S. at some point used to own about 40% of the debt. So if you look at Treasury outstanding, used to be backed by about 40% of that Treasury outstanding used to be backed by gold. Now it's only 2%. So if we go back to even in the 70s, which was about 17%, it would imply a gold price increase of about 2,500 or 1,000 price of gold, or 55 if you go back to the 40% level in the 1940s. I don't know if those are necessarily price targets or hypothetical ideas, not at all. But the point is, I think that those kind of give you an idea of how undervalued the metal is despite this run up. So yeah, the U.S. is in a very difficult position. I shouldn't say, it's flirting with a bigger problem, and it needs to be changing its policies. So it's this is why I thought it was relevant to point out where we are versus other central banks, which have been a clear buying spree of gold.
You're right. So that's very true. We have seen all the support for gold from the central bank buying around the world, not from over here in the Western world. So do you think you do see the U.S. starting that up again?
I think it's been a different run up recently. Like the last 6 to 12 months have been different than the last 24 to 30 months. And the difference is the prior one was definitely driven by BRICS and potentially Chinese investors, Russian investors. And we don't know. We can track the official data, but the official data, it's not explained by the volume we've seen. And so there's a lot of unofficial buying happening, is my point. Recently, I would say it's been more broadly driven, this demand. Western societies have been participating more. And in my view, this is a change in the dynamic. And this is what takes gold much higher. The next leg up for gold, in my view, though, is probably going to be driven by the dollar, is where the dollar, devaluation of the dollar in the U.S. versus other fiat currencies is, to me, where the next support or next pillar of demand is going to come from.
Right, and let's go into the dollar. I know you're here at PDAC presenting on the bear case for the dollar, and unfortunately I didn't get a chance to see your presentation, but maybe you can share some key takeaways.
Well, I think that the key takeaway is I listen closely to people like Stanley Druckenmiller and other macro guys that I think are remarkable in this industry in terms of timing. And some of the things that they usually talk about is this combination of tightening monetary conditions along with aggressive fiscal spending tends to have cause the strength of the dollar. And we have the opposite of that today. We're talking about austerity and we're talking about lowering rates. Again, chicken and egg question. Both of them actually accomplished lowering government spending. And so that combination tends to cause a weak dollar. And then you look at the interest rate that we have policy in the U.S. versus other countries and how much we're paying on that, 5%. Any other economy is paying about half of that, like 2%. Japan is paying less than 1% in terms to service its debt on a GDP basis. And so the U.S. has to lower rates relative to those other economies quite substantially. And that's what usually causes the dollar to have issues. And then the last part of it is that the U.S. dollar today is it's one of its most expensive levels in history. And so the other precedent times was 1985, which was the Plaza Accord, a coordinated act across central banks to reduce the value of the dollar. And the other one was 1933, which was in Great Depression, right before 1931. Most central banks came out and said, well, we're going to lose the gold standard and their currency devalue. And so the dollar surged. And this was not a coordinated act later on because the U.S. just decided to devalue the dollar at the time. So I'm not sure the question, the relevant question is not if it's going to be a coordinated or organic. The point is, I think that the dollar is at a peak level. It's going to be capped. And if that's the case, along with interest rates, this is a green light to a lot of investments, particularly emerging markets. So I'm very bullish on that as well.
Okay. So maybe just a little bit more on the dollar. When we talk about the bear case for the dollar, people can get a little bit maybe carried away and start talking about the depth of the dollar. Is this? Yeah. So for you, how severe are you thinking?
Oh, I don't think you can really trade on the idea of losing the reserve currency. I mean, I that's not my point at all. We've had many cycles of the dollar falling versus other fiat currencies. And this idea of thinking the dollar is the cleanest of all dirty shirts was the right thought 5 years ago. Now we're at a peak. It's easy to report that in the back and say, well, the dollar, yeah, today it is. But the question is, will that be the case in 5 years from now? And I don't think we can continue to have the global economy growing. And I don't think it's also under, maybe even for policymakers, I don't think they can continue to have a strong dollar in this environment, allowing the global economy to grow. That's going to suffocate everything. And so in my view, it's almost like we have to have a weaker dollar. And if you are operating under those conditions as an investor, well, look, you have a scenario for the next 5 to 10 years that probably the dollar cannot, it may not fall apart, but it might not be as strong as it had been in the past. So, plan accordingly. Well, what are things that tend to benefit from not a strong dollar? And, emerging markets, rest of the world, we've seen that basically the U.S. sucking all the dollars and capital of outside of the world. We're going to see a rebalancing back to other things that have been ignored for a long time. And so hence why I think emerging markets should be at one of the top of the list. So, yeah.
Yeah, that's pretty interesting. So emerging markets, how would you suggest investors approach that? Because that's pretty broad.
Well, I agree. I think there's, implications under emerging markets. You have resource exposure countries that I think should be more relevant than others. So I like Brazil. I like South America. I think South America will do very well. South Asia could do very well. Other countries like China, I think there's more tactical ideas there, but I'm not interested in investing in the authoritarian and also issues with, a commodity importer. The same thing goes for Russia. It's a very difficult, case. You can make a contrarian case that potentially the war will end and something will cause Russian assets to do very well. I'm not the right person to do that. I think that we have countries like Brazil, Argentina, Peru, Bolivia. All those countries are providers of energy in general. And so you have Brazil, for instance, has a surplus of electricity that is not being consumed. And you have in the U.S. a deficit about to come because of AI and onshoring. So what you're likely to see is that some of these countries will create partnerships with South America in a big way. Argentina is the first one leading the pack, but that's going to spread to the whole region. And so I am extremely bullish South America and looking to do more things down there.
Okay. So that covers that kind of emerging markets angle. I think I've got a clearer idea of what you're thinking there. If we go back over to gold, I want to bring up the gold stocks because we get a lot of questions on the performance of the gold stocks and why are they lagging behind. I know you've written on Twitter about this pretty extensively, saying that we could be on the verge of a breakout. So tell me your thoughts there. What would be the trigger?
Well, the trigger is these companies need to make money. If you look at the performance of the miners has been tightly linked to how much money they make. Free cash flow per share, or I should say earnings per share recently, were down about 50% from their peak in 2011. So it makes sense that the companies are not at their peak. And so now we're seeing free cash flow, which I think it matters even more than earnings per share, are reaching near all-time highs. That's going to have an impact on shares. And, I think free cash flow is not only going to be retesting the highs of the 2011 levels, but really breaking out in a big way. The gold to oil ratio today is at record levels, or second highest in history outside of the COVID, which gives you an idea of the expansion of the margins. You look at the structure of even the mining costs of the overall industry is probably at around 1,400. Gold prices are double that amount. Even if gold prices fall to 2,500, which would be a pretty significant correction, and could happen, and certainly not my opinion, but it could happen, they would still be making substantial amount of money. And what I find it interesting is that when you look at the margins of, especially companies that are private, that are not, being priced in on a daily basis with their share price, they're doing great. They're making money. They're being able to accomplish, generating cash flow in a large way. And, ultimately, we're seeing a very competitive landscape in the private world. And I think that is going to drive the public markets as well. And one last thing, it was a chart that we put out in our letter that maybe it maybe is underrated in my view, which is the free cash flow per share of the miners, the senior miners, versus exploration stocks. There's a big gap between the two. What do companies do when they start making money? Acquisitions. So, we're starting to see acquisitions across most, mergers between, mid-tiers and seniors, but that's going to flow into the smaller names too, in my view. So very bullish on that as well.
Yeah, this is what I was going to ask you when it comes to the gold stocks. Are you bullish across the spectrum?
Well, I think the seniors are starting to show fundamentals, some fundamental improvements, and that's very, very positive. And I think that they are also extremely cheap right now. And so that'll be one answer. What do I favor? I always favor, and I think this is usually when you have a long-term cycle for mining, exploration is what really outperforms. So I've been very focused on finding high-quality exploration assets because I understand that empirically that's really where the biggest returns will likely come from. And so I want to make sure I'm covered on that front first. Now, owning some seniors and some mid-tier producers and even large producers, I think it makes sense as well. I mean, they're making money. Just to give you some sense, today, if you look at free cash flow yield, so divide annual free cash flow divided by enterprise value of a company, which is market cap and debt, and you compare that with technology companies, this is the first time in a very long time that gold stocks, which are mostly senior companies, are trading at a cheaper multiple in terms of free cash flow, how much money they make relative to technology companies. And so, ultimately, even the generalist people that I've been, in touch with very closely, in fact, are starting to, catch on to the fundamental improvements. And so I think it's a matter of time until money really starts flowing back. It's just my 2 cents on this. Yeah.
Yeah, okay. Okay, I gotta ask you about silver as well, because I've seen you right. It's got one of the most bullish setups that you've seen. And like gold stocks, I think silver has been frustrating for some investors who are waiting for that big move that we've been told is coming. So thoughts on silver. What makes you see it as so bullish right now?
The frustration of everybody. I love it. I think it's it catches my attention. I have a very contrarian way of investing. I love when people hate something. And to me, silver is right on the brink of something really special. What I think it could be a quarterly close at record levels that would, finally make folks believe that this is a real cup and handle formation about to break out. And yeah, technicals matter and so forth, but not as much as fundamentals. And we're not seeing production really rise, so supply remains very constrained. The gold to silver ratio, who would have thought the silver would be trading at 30 plus with gold to silver ratio at 90? What a bullish environment. I mean, this is historically one of the best setups to see a major breakout, and we would still see the gold to silver ratio be at historically high levels. And so to me, this is the beginning of a runaway movement. That could be quite substantial and will be meaningful for the overall industry. We've seen, if you look at silver and track silver prices closely, it's been following very, very tightly with industrial stocks. And so, you look at industrial stocks and you look at silver, they've been kind of in the same line for the last 2 years. Now, what we don't see yet is that monetary aspect of silver to bring on the demand. And I think that's going to be the big story. And so that's why I'm focused on silver so much. I mean, we own, we've done a leverage buyout of the third or fourth largest silver mine in the world, San Cristobal in Bolivia, and we own it privately. And look, it's a wonderful time to be finding leverage to silver, in my view.
Right, and you touched on this a little bit. I was going to ask if, like gold, you would place silver across the spectrum of the miners. Would you look at the metal itself?
Well, I think that the mining industry right now looks very, very compelling. To answer between gold and silver, obviously I think you want to favor silver at this point, just given the lack of performance. But for the mining industry, I'm not sure it really matters because the mining industry overall has been lacking performance. So everything looks cheap in that front. Of course, silver looks even cheaper because if you think it's going to have an even larger run up, then that's something you should be considering, and I do. But it's not easy to find silver miners, anyways. So, it's very rare to find large exposure to silver producers or even exploration stocks or development stories. And so, I just tend to lean on silver. But another metal that I really think could be interesting in this environment is zinc. I can see sentiment on zinc has been terrible. I've been hearing some people talk about zinc, is a terrible investment. There's and the fact is that we're not seeing major discoveries come along, and the amount of zinc we're going to need for the next 10 years relative to where, especially the supply curve of zinc. It's a metal that cannot be recycled, and it's going to be really interesting. In my view, it's probably one of the most asymmetric opportunities as well out there.
Okay, yeah, that's interesting. I've heard maybe some small whisperings on the zinc side, so it sounds like for sure one to watch. All right, this has been really good to go through what you're looking at right now. Any final thoughts that you would leave investors with right now? I know there's a lot going on, and you have a very global macro perspective.
Well, I think that this dollar situation is something that you want to emphasize as much as possible in your thinking because, emerging markets and particularly the derivatives of gold have really lacked performance. And I think that is also tightly held to the fact that the dollar has been so strong. And once that turns, things are going to change quite significantly. I've been I've been following the emerging markets space for a long time, and I haven't found, when you think about the two things that tend to hurt those economies is rising yields and a strong dollar. When you take those two things out of the equation, you have a green light to invest in those places. And so to me, it's something that, the same way gold was interesting a few years ago, I can't help but be looking at emerging markets as well. You look at gold prices versus emerging markets, they usually follow each other closely too. And so, it's a high beta version of gold as well. Just like silver, just like copper also follows gold, all other metals, but also emerging markets, and mainly because they have a large exposure to commodities. And so I'm really bullish on that as well.
Yeah, and I think that connection with gold and emerging markets, that probably really drives the point home.
That's right.
Very good. Okay, well, thank you so much for coming by to talk. This is really good. Always nice to have you.
Thanks for having me. Appreciate it.
Of course. And once again, I'm Charlotte McLeod with investingnews.com, and this is Tavi Costa with CrossCut Capital.